Hi all, this is CA Mithun Kumar Puranam, a small educational tutorial on OECD Pillar 2 guidelines. Yeah, so coming to OECD Pillar 2 guidelines, which is a global minimum tax, the purpose is to ensure tax fairness for MNEs presented by us. Yeah, and what exactly is OECD Pillar 2? It says about 15% global minimum tax on large MNEs, ensure that MNEs pay fair taxes in every jurisdiction, prevents profit sharing to local tax countries. Yeah, yeah. And so, what exactly we will understand more about the Pillar 2 guidelines? First thing is that income inclusion rule, which talks about parent companies must pay top-up tax if subsidiaries are taxed below 15%. That's the first rule. Next comes is undertaxed profits rule, which talks about if the above income inclusion rule doesn't apply, all other countries, rest of the countries can collect that additional top of tax, the difference between existing tax in that particular country, which is less than 15%, to the difference to the tune of 15%. Yeah. And the next comes qualified domestic minimum top of tax, which is commonly called as QDMTT, which allows countries to collect minimum tax locally, avoiding foreign adjustments. Yeah. In terms of UAE, UAE related multinational companies, where it is taxed currently at 9%, if that is the case, and is and um, and rest of the countries and other countries may apply the additional 6% top of tax to make sure that minimum 15% is collected on large MNEs. Yeah? So let us understand who are all affected by this. Yeah, the first one is the MNEs with euro 750 million or more revenue. Yeah, in terms of AED, which comes to 3 billion. For those companies, minimum tax to be collected is 15% in every jurisdiction. So in case of UAE and other where low tax jurisdictions, it has to be levied at the rate of 15%, where currently it is being levied at 9%. Yeah. So the key impact is for MNEs operating in UAE specifically and paying tax 9% may face additional tax burdens due to this pillar 2 implications. Yeah. Coming to the specifics on the UAE part. So on the left side, we are talking about UAE's tax rules. How it got impacted by Pillar 2 is that UAE corporate tax currently at 9%, which is effective from June 1st, 2023. Because of Pillar 2 requirement, now the large businesses may need to comply with Pillar 2. And this QDMTT, the qualified domestic top-up tax to retain tax revenue within the UAE. Yeah. So the overall purpose is that UAE will not lose the tax component of the rest from the difference from 9% to 15%. So going forward, large MNEs need to pay 15% in the UAE jurisdiction so that base erosion is avoided. Yeah. Coming to the next, on the compliance requirements, yeah, and the reporting requirements. MNEs must calculate now going forward effective tax rate per jurisdiction, how much it is coming, and thereby submit information returns for the OECD compliance, and thereafter also maintain financial records and justifications in case they they levy tax which is less than 15%. Yeah? Failure to comply, the penal provisions may apply, and foreign top-up tax applied by other jurisdictions, and additional compliances, penalties, and reporting burdens will be applicable. So therefore, out of this entire tutorial, what we are going through, as I'm giving a walkthrough, the key takeaways will be: OECD Pillar 2 enforces a minimum 15% collection of tax on large MNEs, which so the main crux is the impact on the UAE entity, the large MNEs which are incorporated in this UAE tax jurisdiction, where the revenue is 750 million or more. Yeah, need to uh, they will get additional tax exposure. Yeah, and possible qualified domestic top-up tax adoption in the UAE to retain the tax revenue, thereby avoiding the base erosion from UAE to other countries, and thereby compliance with the globe rules is essential to avoid penalties. Yeah, thank you so much. That's all from today. Wish you all the best. Thank you. I'll come up with the further uh, educational tutorials on transfer pricing relation related uh, provisions. Thank you.